Hey there, and welcome to the first ever Helix Quarterly Market Recap, where we talk about 5 trends that took over the market this quarter and what they mean for you, your business, and our economy as a whole. I'll try and keep each topic to about 60 seconds apiece, but if I go a little over, forgive me. Let's kick it off with the first one, that cloud-native cores are shaking up the future of fintech. If you're like me and you keep an eye on fintech news, you probably already know that Fiserv acquired Finxact and SoFi paid a whopping $1.1 billion for Technisys. What do they have in common? They're both cloud-native cores. And you might be wondering, why all of a sudden are these cloud-native cores becoming so popular? Well, these cores are taking technology that's been around for 50 years and reimagining it in the modern era, building it on the cloud to get you better flexibility, deeper granularity, and a more efficient business model that lets fintechs, technology companies, brands, and banks build products for underserved consumers and build products that are actually customized. As a cloud-native core purpose-built for embedded finance, we at Helix are thrilled to see the growth in this space because, quite frankly, a rising tide raises all ships. It means that all of us can make the economy better, one person and one product at a time. At number 2, we're seeing consumers drive towards fintechs in flocks that we've never seen before. According to a study done by Plaid and the Harris Poll, whereas in 2020, 55% of consumers used fintech products, in 2021, that number ballooned to north of 88%. So what drove more than a 30% increase in usage in 1 year? Well, fintechs are able to build products they could never build before. They're targeting specific problems that consumers have, and they're turning consumers into a first-class citizen, building their whole business around what that consumer needs, and not just how to make money or how to make loans. This is also changing the dynamics between banks and their consumers. There's still a large swath of banks that are providing an excellent digital omnichannel experience to their customers directly, but there are now new categories of banks. There are banks who are acting as issuing banks or banks of record for these large fintech programs. There are banks that are accepting deposits from these fintechs and using them to grow out lending, even if they're not the ones issuing. And there are banks that are using platforms like Q2s to incorporate Innovation Studio and Marketplace and embed fintech inside of their traditional financial services. So you're seeing new business models, you're seeing new usage, and you're seeing a changing definition of what it means to be a bank. At number 3, we have crypto, on the rise with regulation lagging a little bit behind. Between October 2021 and December 2021, we saw global usage of crypto climb from 11.2% of all consumers owning some kind of crypto to 15.5% in just 3 months. Now, the US is a small piece of that at only 0.3% growth in that quarter, but what we're seeing broadly is an interest in crypto as an asset, as a form of currency, and as a means to serve for certain use cases. Look no further than our latest partnership with NYDIG, where we enable consumers to get a part of their paycheck for free in Bitcoin every 2 weeks. All of these things are making it easier to own Bitcoin, transact in Bitcoin, and that's raising the attention of some regulators who are looking at this new form of transaction as something that brings risk into their ecosystem and something that needs to be taken care of. And so keep a close eye on how regulators tackle crypto, as that'll determine how people build products, how people adopt products, and how people use products. Coming in at number 4, we see the rise of alternative lending methods like BNPL changing consumer behavior. As interest rates rise, these alternative lending methods are actually really appealing, particularly to those who are traditionally risky consumers or who had something happen earlier in their lives but still need credit today. For those consumers, BNPL is on the rise. And even for merchants, that equation makes sense. Because, sure, they're paying 5 to 10% in fees to facilitate that transaction. But if the average order price is going up by 20%, that math works out for them. But does it work out for every consumer? That's a question that people and the CFPB are asking as they explore BNPL. And a study by Debanked found that today, about 25% of people that use BNPL are what's called vulnerable, or at risk of something bad happening if they're unable to pay their loans. It's important for us to remember that credit can be an asset if it's used to buy productive means and grow your productivity, but if it's used to buy things that are not productive, credit can be deeply detrimental and cause issues for consumers across the country. So it'll be really critical to build BNPL responsibly to ensure that people who need credit can get it, but we're not encouraging people to take too much credit. And to close us out at number 5, we see rising inflation rates and that impacting consumer behavior. In the last Consumer Price Index report, we saw the CPI drove up 7.9%, or the highest rate of inflation that we've seen in the last 40 years. What does that mean? Well, it means your dollar's worth less tomorrow than it was today, and it also means that we can probably expect rising interest rates. What that means from a consumer behaviors perspective is that today, it's all about debit and spending and credit and lending, as cash is cheap, and it's easy to go and spend that money. But as inflation goes up, rates go up, and potentially the market turns, you'll start to see an increased drive towards saving, responsible money management. You may see an increase in investment after markets dip, and finally, you'll see a rise of things like CDs and other items that are actually incentivized in a world where interest rates go up. So keep a close eye on inflation, and as you're thinking about your overall corporate strategy, build a product that does well in high inflation or high interest rate environments. That about does it for the first quarter of 22. Hopefully today's market recap was helpful for you, and can't wait to see you for the next one.